The stock market often mirrors investor sentiment, reflecting the collective mood and expectations of millions of investors. Recent declines in major indices like the Dow Jones and S&P 500 signal growing unease and potential instability in the financial markets. Inflation remains high, eroding consumer power and making everyday goods more expensive, which in turn affects spending habits. Meanwhile, the Federal Reserve's interest rate hikes raise borrowing costs, making loans and mortgages more expensive for both businesses and consumers. Geopolitical uncertainties and supply chain disruptions add to the perfect storm of worry, causing delays and shortages in essential goods. The current bull market, fueled by historically low interest rates, now faces the reality of slower growth and tighter financial conditions, challenging its sustainability. While it's too early to declare a recession, warning signs are flashing, and investors are becoming increasingly cautious. The stock market decline suggests brewing trouble, with analysts debating the potential for a more significant downturn. The Nasdaq's performance, a bellwether for the tech sector, is particularly concerning, as it indicates broader issues within one of the most dynamic parts of the economy. The Nasdaq Composite Index has entered correction territory, falling over 10% from its peak. Rising interest rates make it costlier for tech companies to finance growth, impacting earnings as spending cuts loom. Regulatory scrutiny and data privacy concerns add to the sector's challenges. The Nasdaq correction reminds us that even beloved market sectors aren't immune to downturns. Investors now demand greater certainty and profitability. The Nasdaq's performance will be key in gauging market confidence. The July jobs report showed the U.S. added 187,000 jobs, exceeding expectations, which is a positive sign for the economy. However, the unemployment rate ticked up to 3.8%, indicating that not everyone is benefiting from the job growth. Moderate wage growth and a slight rise in unemployment suggest the labor market may be losing steam, raising concerns among economists. The Federal Reserve closely watches the labor market for signs of overheating or slack, as these indicators are crucial for economic stability. A tight labor market can fuel inflation, making goods and services more expensive for consumers, while a slack one can stifle economic activity, leading to lower consumer spending and business investment. The Fed faces a delicate balancing act in navigating the current economic environment, trying to maintain growth without triggering inflation. Upcoming economic data, especially on inflation, will guide the Fed's monetary policy decisions, impacting interest rates and overall economic health. Recent market volatility and mixed economic data have injected fear and uncertainty into investors' minds. The VIX, or Fear Index, has spiked, reflecting heightened anxiety. Investor sentiment has turned cautious, with funds flowing out of stocks into safer assets like bonds and gold. This erosion of confidence can become a self-fulfilling prophecy, dampening economic activity. The Federal Reserve and policymakers will closely watch investor sentiment. It significantly impacts consumer and business spending. The current economic landscape is fraught with uncertainty, making it difficult for investors to chart a clear course. With market volatility at an all-time high, the Federal Reserve's fight against inflation has become a central focus, compounded by the ongoing war in Ukraine and the pandemic's lingering effects, which continue to cast a long shadow over the global economic outlook. However, there are glimmers of hope as inflation has shown signs of cooling and the labor market remains robust, providing some stability. The Fed has made it clear that it will continue raising interest rates until inflation is under control, even if it means risking a recession. This delicate balancing act is crucial, as the Fed's credibility is on the line. They must balance price stability with economic risks, ensuring that their actions do not tip the economy into a downturn. Caution and careful consideration will likely guide the Fed's actions in the coming months as they navigate these turbulent times. The recent market turmoil and economic uncertainty are unsettling, but not a reason to panic. Market corrections, while painful, are a normal part of the economic cycle. They offer a chance to reassess portfolios, rebalance holdings, and find market bargains. Investors should maintain a diversified portfolio, invest for the long term, and avoid emotional decisions. Reviewing risk tolerance and aligning portfolios with investment goals is crucial. The U.S. economy has proven resilient, and disciplined investors are well positioned for eventual recovery.